The market in 2024 has been a total roller coaster. One week stocks are up, the next they're tanking. And just when you think you know where things are going, sideways. It's enough to make any investor dizzy. But what if I told you there's a way to get paid while you wait? A strategy that generates consistent income whether the market goes up, down, or even nowhere at all. Today on Elite Trade Club, I'm breaking down the wheel strategy, the ultimate income machine for choppy markets. This is the same premium selling concept that billionaires like Leo Kogwan use, but here's the best part. You don't need billions. You can start with just a few $1,000s. Let's get into it. So what exactly is the wheel strategy? Think of it as a simple two-phase system that just keeps turning. Phase 1 is selling cash-secured puts. Here, you're basically saying, I'll agree to buy 100 shares of a stock I like at a certain price by a certain date. But you've got to pay me up front for that promise. That upfront payment is called the premium. And as long as you have enough cash to buy those 100 shares if you're assigned, it's called cash secured. Now, phase 2 is selling covered calls. Once you actually own the stock, you flip the script. You sell someone else the right to buy those shares from you at a set price. And guess what? They pay you another premium. So the cycle looks like this. 1. Sell a put. 2. Either keep the cash if it expires worthless or get the shares at a discount. 3. When you get the shares, start selling calls on them. 4. When your shares are called away, go back to selling puts. That's the wheel. It's systematic, it's repeatable, and it generates income every step of the way. The wheel isn't new. It's been used by professional traders for decades under different names, like the triple income strategy or options rotation. What makes it timeless is how it uses probabilities and time decay to work in your favor instead of trying to predict the next big move. Let's run through this with a real-world example so it actually clicks. For this demo, we'll use Advanced Micro Devices, ticker AMD. As of mid-2024, AMD trades around $165 a share. It's a hot stock because of its role in the AI revolution, but like most chip makers, it's volatile. Perfect for the wheel because volatility equals juicy option premiums. Step 1. Sell a cash-secured put. Let's say you believe in AMD long-term, but wouldn't mind getting in at a discount. You sell one put contract with a $160 strike price expiring in about 45 days. The market is paying $5 per share for that put. Since each contract controls 100 shares, that's $500 cash in your pocket right now. But you do have to set aside the cash to buy 100 shares at $160. That's $16,000 reserved in your account. Here's the math. Premium received, $500. Capital required, $16,000. Return, $500 divided by $16,000 equals 3.1% in just 45 days. Now, imagine repeating that every 45 days across a full year. Even if you only capture half that return each time, you're still looking at an annualized yield between 20 and 30%. That's the power of compounding short-term income plays. Now, two things can happen. AMD stays above $160. Your put expires worthless. You keep the $500. You never even touch the stock. Then you sell another put and repeat. AMD falls below $160. You get assigned and have to buy 100 shares at $160. But remember, you collected $5 in premium, so your real cost basis is $155 a share. You just bought AMD at a discount. And now you move on to phase 2. Step 2, sell a covered call. Now you own 100 shares at an effective $155 price. What's next? You sell a call. Pick a strike price you'd be happy to sell at. Let's say $165. The call expiring in about 45 days is trading for $4 a share. That's another $400 cash up front. Here's how this plays out. If AMD stays below $165, the call expires worthless, you keep the $400, and you sell another one. If AMD rises above $165, your shares get called away. You sell them at $165. Your profit? $10 per share from $155 to $165 equals $1,000, plus $500 from the put, plus $400 from the call equals $1,900 total profit in about 3 months. Not bad. You're collecting rent on your stocks, win or lose. Now, before you run off and wheel every stock under the sun, let's slow down. The wheel has risks, and you need to know them. Capital requirements. This isn't a tiny account strategy. you need at least 15 to 20K per stock you're running the wheel on. Why? Because you have to secure enough cash to actually buy the shares if assigned. The risks. 1. Assignment risk. If the stock drops below your strike, you will own it. That's the point. Be ready. 2. Downside risk. Let's say AMD crashes from $165 down to $120. Even though you bought in at $155, you're still sitting on a big paper loss. The wheel cushions you, but it doesn't make you bulletproof. Another key factor is volatility. The higher the implied volatility, the more premium you'll collect, but also the greater the chance of assignment. A good rule of thumb is to sell options with a delta between 20 and 30. That gives you a balance between income and safety. And never stack wheels on too many stocks at once. Diversify across sectors to keep your risk under control. 3. Capped upside. This is the big one. If AMD moonshots to $200 while you sold a $165 call, you're stuck selling at $165. You made a profit, sure, but you missed the rocket ride. So what's the solution? Best practices. Elite best practices, pick quality stocks. Only run the wheel on companies you'd happily hold long term. AMD, Apple, Microsoft, SPY, QQQ. Don't wheel junk. 30 to 45 days to expiration. That's the sweet spot for option premium versus time decay. Rolling options. If a put is getting close to being assigned and you don't want the stock, you can roll it to a later date at a lower strike, often for another credit. Same goes with calls. This keeps the wheel turning smoothly. So is the wheel strategy for you? Here's the truth. It's fantastic if you want structured mechanical income. It's perfect in sideways or slightly bullish markets. It forces discipline. You're not chasing hot trades, you're collecting steady premiums. But it's not magic, it's not risk-free, and it's not a get-rich-quick play. If you believe in the stocks you're wheeling, and you're okay with tying up cash, it can be a fantastic long-term strategy. You literally get paid to wait for good entry points, and then can get paid again while you hold. Most experienced wheel traders aim for 2 to 4% per month. That might not sound huge, but compounded over time, it adds up fast. The real edge isn't in giant wins. It's in repeatable cash flow that builds over years. Whether the market rallies or stalls, your portfolio keeps generating income like a rental property that never sleeps. Let's recap. The wheel strategy is simple. Sell a cash secured put. If assigned, own the stock at a discount. Sell a covered call. Repeat the cycle for consistent income. Would you use the wheel on AMD, SPY, or maybe even Apple? Drop your thoughts in the comments. I'd love to hear your target premium goals. And if you found this breakdown helpful, do me a favor, smash that like button, subscribe to Elite Trade Club, and hit the bell so you don't miss more strategies to level up your investing game. Thanks for watching. I'll see you in the next one.